Hey, it's Tyke Randall with Credit Suite, and in this short training, I want to introduce you to commercial real estate financing. I want to teach you what it is, how it works, and everything you need to know to be able to buy or refinance a commercial building. So by the end of this training, you're going to know the ins and outs of commercial real estate financing, the rates you're going to get, the qualifications, everything you need to know to be able to get approved. So commercial real estate financing is financing you can get for the purpose of typically constructing, refinancing, or actually purchasing commercial real estate. Now, it could be used for a lot of different things. A lot of people actually use commercial real estate financing to buy investment property. So they're actually buying, for example, office buildings that they're then coming out and leasing to other people. A lot of others actually use commercial real estate financing to be able to finance their own building for their own purpose. A lot of people then even use commercial real estate financing to do both, where they're actually even buying a location where they're going to house their own office, and then they're also going to have other tenants there as well. So whether you're building or whether you're buying or whether you're even refinancing a commercial building, commercial real estate financing is a great option to consider, where you don't have to put as much cash into the transaction and you're able to get really favorable terms. So what kind of terms are you looking at? Well, commercial real estate, typically we're looking at 20 to 30-year loan terms. Now, you can get shorter term financing, and sometimes if you're getting a bridge loan, if you're getting a hard money loan, even a soft money loan, which we'll talk about in a few minutes, then the terms are a little bit shorter. But on the better types of real estate financing, for example, SBA 504 loans and other kind of fintech and conventional financing, you're able to get terms as much as 20 to 30 years. You're typically able to get interest rates as low as 4 to 8%. So the long term and the low interest makes it very affordable for you to actually be able to come in and qualify. Now, what's nice about commercial real estate financing is we find in a lot of cases, you're able to buy the building that you're renting or leasing and do so with little to no money down and even lower your overall payments. So we're seeing a lot of that happening post COVID-19, where there's a lot of opportunities and people are actually buying the buildings that they've been leasing or renting, have lower payments than they were paying for lease or rent, and they're buying them right so they can get in with little to no money down. Now, typically for commercial real estate financing, you're going to need about a 20% down payment. That's called a loan to value. So when we look at how much of a loan that you're getting compared to the value of the property, that percentage is a loan to value. And typically, they want you to be borrowing no more than 80% of the value of the overall property. But if you're buying a property right, well, then that helps you actually need less money down to make the purchase. And you're able to tap into all other kinds of financing that you can even use for your down payment. So for example, you could use revenue lending, you could use a merchant credit line, you could use the actual credit line hybrid program that we have. There's a lot of creative ways you could get money that you need to actually cover even the down payment that you require. But most types of financing are going to range from about 55% to 80% loan to value, which means you're going to need down anywhere between 20% and even 55% or more, depending on your overall risk. So let's look at risk. So when they look at qualifying for a commercial real estate property, there's several things that we really want to take into account. The first of all is we're looking at what's called a debt service coverage ratio, so a DSCR. And what that really has to do is what they would like to see is that the property is bringing in enough money from its rents to actually cover the mortgage payment plus like 25%. So that's called a DSCR of about 125%, which is what lenders would really prefer to see. And what that basically means is, let's just give a simple math example, is that if you're coming in and your mortgage payment is $1,000 a month, then what the lender would love to see is that you're actually bringing in more than 125% of that, which is $1,250 a month in rents. So let's say you come in and you get a location that has 3 different places in it. You're going to occupy one and there's renters in the other 2. Well, best case scenario, they would love that those other 2 units are rented and that the rents are more than 125% of what your actual mortgage payment is. So in that example, if you're collecting $1,250 from those other 2 and your mortgage payment's only $1,000, they love that because what you're collecting in rent is 25% above and beyond what your mortgage payment is even going to be. That means that you're bringing in enough in rent to actually cover a lot of your expenses, including the actual mortgage payment itself. Now, obviously, it doesn't work that way if you're actually getting a commercial property for yourself. So in that case, they're going to want to look at your tax returns. They're going to look at your bank statements. They're going to make sure that you have enough net profit to cover the actual mortgage payment. But look, All kinds of commercial financing is the same way. The lender cares most about your ability to repay that loan. It's just a little bit different with commercial real estate because they're looking for the property itself to actually pay for the mortgage itself. They're looking for the rents of that property to cover your overall mortgage payment. So the other things they're going to look at is credit quality. It's going to help you a lot if you have established business credit. As a matter of fact, it's not uncommon to get commercial real estate financing in your business name, not in your individual name. But of course, in order to do that, you've got to establish your business credit. If you need help with that, you can go to creditsuite.com/EIN to grab our free guide that'll map out the steps. They're going to want you to have good consumer credit. If you have really good consumer credit, you can start qualifying for SBA loans, which are longer term and better interest. But if you have more challenged credit, you can still get financing. It's through a different kind of funding program, typically a hard money or a soft money type of loan. So speaking of which, what kind of loans are available? Well, there's a lot. When it comes to commercial real estate financing, the best is SBA. SBA has a 504 loan, which is specifically designed for the purpose of purchase or refinance of commercial real estate, long-term, low interest rate. Conventional banks have other kinds of commercial real estate financing as well. Your debt, you can definitely get some from online lenders or fintech lenders or marketplaces as well. Fannie Mae, Freddie Mac. You're even able to get them from hard money or soft money lenders. And hard money lenders are basically dealing with the hardest risk that's associated with commercial real estate financing. And soft money's not as much risk as hard money financing is, but still more risk than you're going to find with conventional loans. So what I mean by all this is that even if you have challenged credit, even if your revenue isn't high, even if you're a startup, there's still solutions there because there's this wide spectrum of money available, from hard money loans where the interest is a little higher and the term is a little shorter, even bridge loans, which bridge the gap between you getting long-standing financing like conventional financing or 504 loans from SBA. And then there's that SBA 504 conventional financing with long terms and low rates. So there's a lot of ways to creatively keep your payments low, even get the money you need for the down payment, making it very practical for you to be able to own a commercial building. And when it comes to buying a business, when it comes to you selling your business, commercial real estate, owning the real estate is one of the biggest things you could do to make your business worth considerably more money. So not only will owning your own real estate make your business worth more money, but again, you're even often able times to do so for less money than you would pay renting or leasing of an actual property. So that's the main things you need to know about conventional real estate financing or commercial real estate financing. You know, the sources you can go to get it. You've kind of got this broad range of interest from 5 to 8%. If you're dealing with SBA, you can even get as high as 10, 12, 15% interest if you're getting it from hard money lenders. We've talked about down payment. Almost all types of commercial real estate will qualify. And there's a long list, too long to go through here. But whether we're talking about multi-unit or storage facilities, there's so many different types of commercial real estate. Most of it will qualify for commercial real estate financing. We talked about debt service ratios and so many other things that you need to know. So if you're interested in getting approved to buy or refinance or even take cash out of a commercial building, get in touch with us, creditsuite.com/get funding. That's creditsuite.com/get funding. So you can own your own building, whether it be for the purpose of renting for your own location or even renting to other people and turning it into a positive cash flow investment property. A lot of options. If you'd like to talk more, visit us online at creditsuite.com/get funding.